Hi everyone, welcome to the exam review recording. This is our last lecture recording, and I'm very proud of you guys come this far, and I appreciate you still pay attention and want to do well in this exam. The exam 3 is gonna be in our final exam, and it's not comprehensive exam. We're only gonna test in chapter 8 to chapter 11. And so first of all, let's look at the chapter 8, what would be covered. Chapter 8, we are majorly trying to understanding the inventory measurement system. And I didn't want you to have too much things going on, remember, because there's a lot of stuff. And then the most important things is the 3 things I want you to remember, right? First of all, I want you to remember what's the difference between the perpetual system and the periodic system. And second, I want you to understanding which inventory cost system will result in a high ending inventory. And also remember that this question is a conditional question, means that it's circumstantial. And then when you have a judgment of what kind of cost system will result in high inventory, you have to ask yourself another question, right? So the question is, what is the condition about this conclusion, right? Okay, so 3 is that what is a LIFO liquidation and why there is a LIFO liquidation, right? So basically, chapter 8, the content in the exam is more theoretical. Okay, so the slides is arranged as a sequence of the questions. So it's gonna, chapter 9, 10, 11 gonna be like that as well. Okay, so the first exam question is the perpetual system versus periodical system. Perpetual system, first of all, it allows continuously updates the inventory account, right? So everything is debiting on the inventory. And crediting cash if you purchase, right? If you return, you credit inventory, right? And if you sell, you debit cost of goods sold and credit it out inventory as well. So everything, buy, sell, return, and everything is directly marked under inventory account, right? For each change in inventory caused by purchase, sales, return, and it also continuously adjusts cost of goods sold account each time goods are sold or returned by the customer, right? Okay, so the periodical system, if you remember that adjusting inventory accounts and record the cost of goods sold only at the end of each period. That's because that periodic system, we needed to have a physical inventory account, right? Counts. And then that's when we can figure out what is cost of goods sold, what is ending inventory. So this records the merchandise purchase return, and purchase discount and freight in a temporary account. For example, it's purchase, you were debiting purchase and crediting cash. If it's a return, you were debiting return, right? You're crediting return, inventory return, and then you're debiting cash, right? So, and if it is freight in, you were debiting freight in and crediting cash. And in the end, you will figure out using this equation, right? So in the periodic system, to determine the cost of goods sold, you have to use an equation to solve it, which is equals to beginning inventory plus net purchase and minus ending inventory to figure out what is the cost of goods sold. And also be careful, net purchase here equals purchase minus the purchase return. So it might in multiple choices that give you saying that the company is under periodical system and give you a bunch of numbers and then ask you to figure out what's the cost of goods sold, right? It might ask you, say, under the perpetual system, give you a bunch of numbers and ask you to figure out what is the ending inventory, right? So this is what I want you to remember. Basically, In a perpetual system, everything charging on the inventory. On the periodic system, everything charging in different name of the account. And in the end, we combine them together to figure out the cost of goods sold. And the ending inventory here is because you physical count it, hence that you understand the ending inventory. Okay. And okay, second question is which inventory cost would result in high ending inventory? Remember, there's a condition about the conclusion. What's the condition? So here's the thing. The condition is the pricing of the inventory. During the rising cost situation, FIFO will result in very lower cost of goods sold and higher ending inventory, right, than the LIFO. And then during declining cost, FIFO will result in a higher cost of goods sold and lower ending inventory than for LIFO. So this way, you just need to remember one side. So let's say during the rising cost, which is much normal, right? So the LIFO, the ending inventory, right, is always going to be cheap because remember, if you bought at 1 in January 1st, and then the rising will be $3 a unit in March 31st, and then October 30th you are getting $5, right? So, and then this is a condition of rising cost. So if we use the LIFO method, you will sell this layer first and then this layer. Hence that ending inventory will be very cheap at $1. So, and on the FIFO method, right? FIFO method, which is a sell from the bottom. So FIFO is $1, $3, and $5. And this is January 1st, March 31st, and October 30th. On the FIFO method, when the price is rising, right? If you will first sell the $1 layer and then $3 layer, hence the ending inventory is going to be $5 here. Hence that this sentence saying that the FIFO result in lower cost of goods sold, right, which is $4 rather than $8, and higher ending inventory than LIFO. That's exactly true, right? And then during the declining cost situation, let's say if we are having a situation as declining, which is a $5 at January 1st and $3 at March 31st, and $1 at October 30th. So this is a declining cost method. So under LIFO method, which we consume the early layer, latest layers first, and we left with $5 as ending inventory, right? So LIFO will left of $5. However, if you see, if we draw the same thing again, so $5 in January 1st and $3 on March 31st and $1 in October 30th. So this is a declining of the cost, right? So under these circumstances, if it's the FIFO method, we will consume $5 and $3 and left the $1. So FIFO, the ending inventory, will be only $1. Hence that when there is a decline in the cost of FIFO will result in a much higher cost of goods sold, exactly $8 versus $4, and a lower ending inventory than LIFO. So $1 versus $5, right? Okay, so in nutshell, that LIFO in normal circumstances, which is the rising cost, it will have a much lower, right? Much lower ending inventory comparing to FIFO. Okay. So what is a LIFO liquidation and why there is a LIFO liquidation, right? This is learning object 6. So on the LIFO method, the last unit purchased are assumed to be sold first, right? In some periods, the number of units sold will be greater than the number of units purchased. So if I have a layer, let's say 2,000 units at say $1, and then because the cost is rising, right? So the rising cost, and then I bought This was last year, right? So this year I bought 3,000 units at, let's give it a little bit extreme, $10 a unit, okay? Because the price increase. And then the selling situation in the year 2, this is the year, current year, right? And then also in current year, I sell, say, 4,000 units. So that means that on the LIFO method, I will start to selling all of this 3,000 at $10 each, and I also have to sell one layer, like 1,000 units at the like at you know, the early layers, right? And this 1,000 units at the early layers is called LIFO liquidation. Okay, it's a kind of like the number of units sold, which is 4,000 units, is greater than the number of units purchased, which is 3,000 units for this period. So in this kind of circumstances, previous year's layer, which is a 2,000 units layer, are recorded as sold, right? Because we ran out of things to sell because we purchased less than what we sell. When we purchase less than we sell, we have to, you know, dig out the earlier years layers to sell it. Okay, and this instance is called a LIFO liquidation. And normally, as you can see, when you sell, say, the product at the $20 a unit, right? So sell price, because the price on the current year was $10 as a cost, hence that you might charging $20. But your income for this 3,000 units will be $10 each. However, because you have a LIFO liquidation, then your profit will become 20 minus 1 is 19 for the 1,000 units, right? And for the 3,000 units, it's going to be 10 because it equals 20 minus 10 equals 10, and it will be 3,000 units. Hence, LIFO liquidation will jack up your net income profits a lot because early layers are very cheap. And if you purchase less than you sell under the LIFO method, you will often run into a LIFO liquidation. Okay, so I want you to conceptually understand it, but if you have a hard time to remembering what it is, look into the learning object 8-6. Okay, so now we're moving on to chapter 9. I have 6 questions or concepts that you need to remember, right? First of all, chapter 9 is still about the inventory. It's things related to additional issues about inventory. First of all, I want you to understand what is the lower cost of net realizable value and how to use it, when to use it. And what is the lower cost of a market method, and determining the carrying value of inventory using lower cost of a market method, and understanding the tax implication of LCM method, right? And also, what is the gross profit method and when to use it and how to use it? And what is the retail inventory method and the difference between conventional retail method and the average cost method, right? And what is how to estimate the ending inventory and cost of goods sold on the average cost of retail method, and this will be very important, okay? And how to correct inventory errors. Okay, so first of all, after we acquire inventory and it's sitting, if we didn't sell it, it's sitting on the shelf, right? Which is we have to understanding the expected benefits of unsold inventory. Sometimes will fallen below the cost because you know, like spoilage or molding or you know, the market value is gonna drop, such as if you didn't sell a computer that was made like 3 years ago, I guess that computer cannot be recovered the cost because the market competition is such fierce, right? So hence that company must make an adjustment entry known as inventory write down to reduce the inventory that's sitting on the shelf haven't been sold to the net realizable value, right? Hence, such reduction will have effect on the inventory account on the balance sheet and net income on the income statement. So therefore, the measurement approach usually have a two measurement approach to write down the inventory. And one we call LCNRV, which is lower of cost or net realizable value. It's a mouthful. And then this method can apply to any kind except LIFO and retail inventory method. Okay, so such as FIFO, average cost, and any other inventory. Be careful. This method cannot apply to LIFO and retail inventory method. Okay. And the result of such adjustment will be, of course, reduce the reported inventory and reduce the net income. So since LIFO and the retail inventory method cannot use the LCNRV method, then what we should use then? We will use a lower cost or market method to evaluating the write down of inventory on the LIFO or retail method. And the financial statement implication is the same. It's to reduce the reported inventory and reduce net income. Okay, so first of all, lower cost of net realizable value. So first, how do you calculate net realizable value? It equals the estimated selling prices minus the cost of completion, disposal, and transportation. So NRV is a net amount that a company can expect to realize from sale of inventory. And so at the end of the inventory, how to use it, a company needs to compare the cost of its ending inventory to inventory's net realizable value. So if net realizable value is lower than the cost, then the adjusting entry needs to be written. So we will reduce the inventory from its already recorded purchase cost to the lower amount. If the cost is lower than the NRV, there's nothing you need to do. So, okay, here's an example. SLR Corporation has 1,000 units of each of two products in its year-end inventory. And per unit data of each of the products are follows, right? So we have a cost of 50 for product 1, and product 2's cost is $34. And the selling price for product 1 is $70 and product 2 is $36. And the cost to sell the product 1 is $6. Cost to sell the product 2 is $4. So determine the carrying value of SLR's inventory, assuming that the lower cost or net realizable value rule is applied to individual product. Okay, individual product. What is the before tax income effect of LCNRV adjustment? So first of all, before we going forward, we know that LCNRV method, the most important thing is what is NRV, what is net realizable value. For product 1, right, we were using the selling price minus the selling cost of sale, which is going to be $64. And the NRV for number 2 cost is going to be $36 minus 4 is $32, right? And then hence that we need to compare this two number with the cost. The cost of product 1 is 50 and the cost of product 2 is 34. So as you can see, 34 is smaller than the 32 is smaller than the 34. 64 is bigger than 50. So that means that if we do the lower cost of net realizable value, we'll pick 50 and we'll pick 32. And there's 1,000 for each unit, right? So that will be that product 1 will be valued at $50,000 and product 2 multiple 1,000 is going to be $32,000. So that means the total cost should be, after write down, should be $82,000. However, right now, currently the cost of the inventory without write down is going to be 50 multiple 10,000 plus 34 multiple 10,000, right? It's going to be $84,000, right? So hence that we needed to write down about $84,000 minus $82,000, $2,000, right? Amount of write-down. Okay, so lower cost of a market is actually only applied to LIFO method, right? Okay, and then as I hope you remember, there is some sort of the replacement cost, right? And then, but you have to judge whether the replacement cost is between ceiling or floor. So if the replacement cost is higher than ceiling, we pick ceiling. If the replacement cost is lower than floor, we pick a floor. And then we use the corrected adjusted replacement cost. We call it the market cost, right? After you picking the correct amount of replacement cost, we give it a new name, market cost, and we comparing the book cost, which is the purchase price, whether it's bigger or smaller than market value, right? Okay, so let's look at an example. And the ceiling, do you remember? Ceiling is net realizable value, which is what we just calculated. And the floor is net realizable value minus normal profit margin, right? Okay. So let's see this one. Similar, SLR Corporation has 1,000 units of its two products in its year-end inventory, right? And the per unit data for each of the product are as follows. So cost for product 1 is 50, cost for product 2 is 34. Replacements cost, okay, is a 48 and 26 for product 2. Selling price is 70, selling cost was 6, and normal profit is 10. And product 2, so selling price is 36, selling cost is 4, and the normal profit is 8. So what I usually do is, if I see LCM, the first thing I will say ceiling. I will calculating a ceiling, and I'm calculating a floor. Product 1, product 2. The ceiling I know is NRV, right? And the floor is the NRV minus the profit, right? So the NRV here for product 1, I know is 70 minus 6 is gonna be 64. For product 2 is gonna be 36 minus 4 is 32, right? Selling price minus the selling cost. The floor will be the NRV continuous minoring the minus the profit, which is gonna be 64 minus 10 is 54, and for number 2 is 32 minus 8 is gonna be 24, right? And then I look at the replacements cost. Okay, so the replacements cost for number 1 is 48, and for number 2 is 26. So I will judge whether those two numbers are between these two range. 48 is between this and this. No, okay. 48 is falling beyond, smaller than the floor. Hence that I cannot use 48. I have to pick this number, right? Because we say that the replacement cost, we wanted to make sure the market cost has to be between these two numbers, and then the currently replacement cost is fall outside of the floor. Hence that we need to pick the floor instead of 48. And the replacement cost for number 2 is 26. It's between these two numbers, right? 32 is bigger than 26. 24 is smaller than the 26. Hence that this is gonna be our correct number for market. Okay. Then so we know that LCM judged, after LCM judged, and then we will comparing the real cost, the book cost, which is currently one is 50, and cost of product is 35, and the market cost. After this whole exercise, I know the book, the number 1 should be 54, and number 2 should be 26. So comparing the lower cost of market, I find out that the product 1 should continuously keep the book value, which is 50. However, the second product should drop to 26, because 26 is the market cost, right? Okay, so therefore the new costs of the inventory should equals 50 multiple 1000 plus 26 multiple 1000, and it should equals to $76,000, right? Okay, and the current cost of inventory should be, you should be using these two numbers, right? So 50 multiple 1000 plus 34 multiple 1000, and it's actually $84,000. So that means that you needed to write down about $8,000, right? So in other words, that before I consider comparing the cost with market cost, I need to figure out how reliable this replacement cost is, right? As you can see, this 48 cannot be used because it fell out of the range. So that means that the first thing I do whenever I see the LCM, I think about the ceiling, I think about floor, and I compare the replacement cost within this data range. And I figure out what is supposed to be the market cost. And then I go compare book cost with market cost, and I figure out what is the total updated cost. Okay. Okay, and then I want you to understanding the gross profit method. The gross profit method is also known as gross margin method, and it's very useful in situation when the inventory are such as in determining the cost of inventory when it's lost or destroyed or stolen, right? Or in estimating inventory or cost of goods sold for interim periods, avoiding expenses of physical inventory count, or in the auditor's testing of overall reasonableness of the inventory amounts, or in the budgeting and forecasting. So usually people use gross profit method in auditing's job. So basically, if you know that the profit margin is 20%, right? And you can figure it out whether the ending inventory is correct number, right? Because you know the beginning inventory from what you audited last year, and then you can figure out the purchases, right? And then you can figure out the cost of goods sold, and then you can figure out the ending inventory. Okay, that's the logic. And then how did you figure out the cost of goods sold? Because you know the sales, right? And sales minus 20% profit margin multiple sales can give you the cost of goods sold. And you know the purchase because you have original material or receipts, right? You can figure out whether the ending inventory is reasonable. That's what auditor can use. Another method and another situation is when there's a fire or a flood that destroy the whole inventory, and no one has been using perpetual system, and then hence that how much inventory was left in a warehouse before there was a fire, and you can use this method to figure it out, such as this example. On February 26th, a hurricane destroyed the entire inventory stored in a warehouse owned by the Rockford Corporation. The following information is available from the records of company's periodic system. Beginning inventory is 220,000. Purchase and net sale from beginning inventory through February 26 was 400,000 and 600,000 respectively. And the gross profit ratio is 30%. So what we wanted to know is the estimated cost of inventory destroyed in a hurricane. So basically, what was the ending inventory in the warehouse before, right? Before hurricane. Okay, so what we do here is, ending inventory equals beginning inventory plus purchase minus cost of goods sold. So we know the beginning inventory is 220,000, right? And the purchase we know here is 400,000. And then how do we know cost of goods sold? Okay, this is a good question. So cost of goods sold can be figured out from this ratio. Okay, think about cost of goods sold can be equals to sales minus profit margin, right? Right, because you charge people $20 and then you wanted to make $5 of profit, so that means your cost of goods sold should be $15, right? Hence that if you are knowing the gross profit ratio, that means that sales minus sales multiple profit ratio, gross profit ratio, right? So, and we know that sales in this question is 600,000. And we know the gross profit margin was 30, so which is 600,000 multiple 30%. And then this will give us $420,000, right? So if we know hence that this will be the cost of goods sold, $420,000. So therefore, if you carry out this calculation, you find out 220,000 plus 400,000, 620 minus 420 is going to be 200,000. So hence that the cost of inventory destroyed should be 200,000. Okay. So the interesting part is the cost of goods sold can be deductively calculating if you know gross profit ratio. Okay. So inventory errors, right? So I know we had a homework. It's pretty tough, that question. But I will not test you that difficult. All I want you to know is that the inventory is such big deal. If you made mistakes, no matter in purchase or in ending inventory, you can mess up a lot of stuff, right? So because there's a relationship between the cost of goods sold and net income can mess up return earnings, right? So for example, if you if you over-recorded net purchase, that means that your cost of goods sold is going to be overestimated, and then they're going to carry over to the income statement. The income statement have too much high cost of goods sold, you will have a low net income. If you have a low net income, I mean low is underestimated net income, that if anything else is correct, then that means your ending return earning going to be low, right? Vice versa. So hence that an error in recording purchase or calculating any inventory can affect the cost of goods sold, net income, and return earning. So let's look at an example. So in 2021, Winslow International Inc.'s controller discovered that the ending inventory for 2019 was overstated for $200,000. So determine the effect of error on return earning on January 1st of 2021. So basically, you made mistakes in 2021, which 2021's January 1st, right? So basically, it's asking what is the effect of determine the effect of return earning on the beginning of 2021. That means what is the ending effect of return earning in 2020, right? And then this mistake was made in 2019. So let's look at how it goes from 2019 to 2020. So first of all, the discovered ending inventory is overstated. So beginning inventory is correct, plus purchase is correct, and then minus ending inventory equals cost of goods sold, right? And then the mistake was that 2019's ending inventory is overstated. Hence that the cost of goods sold should be underestimated, right? So if you bring this to the income statement, the revenue, so on the circumstance, the revenue was correct, right? And the cost of goods sold is underestimated. Hence that the net income is overestimated. And the net income carried over to return earning. So basically, beginning return earning was okay. So carried over to the balance sheet, right? Beginning return earning is the same. and then plus net income, which is increasing, hence the ending return earning should be increasing, right? Okay, so, and then in 2020, what happened? 2020 is that the beginning inventory, which is carried over from the ending inventory from 2019, was overstated, hence that the beginning inventory of 2020 is overstated, right? And so plus purchase, let's say purchase, they didn't say anything wrong, so it was correct. And minus ending inventory, the controller didn't say anything wrong with ending inventory of 2020. And hence that the cost of goods sold in 2020 is overstated because this overstation coming from ending inventory overstating of 2019, it get carried over to 2020, hence that the cost of goods sold is overstated. So cost of goods sold overstated, and then the revenue minus the cost of goods sold, overstated cost of goods sold, the net income, right, is going to be underestimated. Am I right? Because the cost of goods sold is overstated. If you carry it to the net income, when a number minus overstated number, that will be the net income is understated. So the understated net income in the balance sheet, you have beginning retained earning, who is overstated because, look at here, because the ending return earning in 2019 was overstated, hence the beginning return earning in 2020 is overstated as well. But the net income here, the net income is understated because you carry it over, and then hence that the ending return earning is going to be canceled out, corrected, right? Okay, so hence that the ending return earning, which is the beginning return earning for 2021, is corrected because it's canceled out, right, for 2 years. Okay, so this doesn't not always happen, right? What if this question is asking January 1st of 2020, whether what's the effect of the errors on the return earning? Then you will say it's overstating the return earning. But the question is asking what is January 1st, 2021? You will find out that if you go through this logic, you will find out that the mistake is canceled out, right? But be careful, in the questions, in the exam, it might not cancel it out. You have to go through the steps. Okay, so the answers here, you can read here. So the arrow, 2019 arrow, caused the 2019's income statement to be overstated, right? Okay, and but since 2019's ending inventory is 2020's the beginning inventory, 2020's net income is understated, right, by the same amount. So income statement was misstated for 2019 and 2020, but the balance sheet, which is the return earning, was incorrectly for 2019. But after that, no account balances are incorrect due to 2019's error. Analysis as follows. Okay, so the last segment of knowledge is retail inventory method, and I want you to know how to do average cost method. Okay, and I want you to know what's the difference between conventional retail method, okay, versus average cost method. So first of all, this retail method, namely, it will always using on the high volume retailers because they sell too many different items, and each item's cost is quite low. And in order to do this, you first of all, you have to estimating amount of ending inventory at the retail prices. How do you do that? You want to find the amount of ending inventory at the retail, then you need to understand what is the cost of goods sold at the retail price, and then minus the sales, right? And then you finding out the inventory cost by multiplying the current cost to retail percentage to estimate any inventory at cost, right? And the cost to retail percentage is the goods available for sale at cost divided goods available for sale at retail. And this is an average cost system. So if you want to using conventional retail system, be careful not to including net markdowns, only including net markups. And the average cost method including both net markups and net markdowns. Let's look at example. Okay, San Lorenzo General Stores using a periodic inventory system and a retail inventory method to estimate ending inventory and cost of goods sold. The following data available for the month of October 2021. Okay. So the beginning inventory give you the cost, and the net purchase give you the cost, and retail give you a beginning inventory retail price and net purchase retail price, and also marked ups, markdowns, and net sales. Okay, and the question is, I want you to complete the table below to estimating average cost of ending inventory and the cost of goods sold for October using information provided. So hopefully you guys can use the online system, which is connection system, or instead of the Word document. As you know, that last exam you guys use Word, is kind of slowing you down. So this time I set up the exam non-proctor enabled, so you would not have a problem unless the connection failed, right? In other words, working using connection is working for you, is on your side, right? Instead of using Word document. So hence that if you guys are lucky enough to get into the system, then the table below, it will show you certain information. What we need to do, so here for demonstration purpose, I will write everything, okay? So here I just don't want to repeat, I will using on top of this table. So in other words, that first of all, you will have a cost column and a retail column, right? And then you wanted to calculating cost to retail ratio. And then the cost to retail ratio is actually equals to this all costs available for sale divided all costs for available sale at retail price. And then which is gonna be using beginning inventory, right? And plus net purchases. And you will want to including all the markups and markdowns, right? Adding markups and minus markdowns, because this is not a conventional method, right? Conventional method, you will leave markdowns outside, but this is average cost, so that means it's okay. So then you can come up with the goods available for sale. And then now I just religiously put it together. So right, so cost is 35,000 in terms of cost, and net purchases is only going to be 19,120, right? That's it. And the retail prices for these things are a little bit complicated. So the retail is 50,000, and the net purchase is 31,600. Markups is 1,200. And minus 800 markdown. So the retail prices altogether is going to be $82,000, and the cost itself, if you're adding all this up, is going to be 54,120. So therefore, the cost to retail percentage is going to be 54,120 dividing 82,000, and which is going to equals 66%. Okay. So hence that we know that the net sales, right? We know the market price of the retail price of net sales is 32,000, right? We minus the 32,000. Hence that we know that the ending inventory of the retail price, if you use the 82,000 minus 32, is going to be $50,000, right? And then $50,000 if we translate it at the cost of the ending inventory, right? So that will be 50,000 multiple 66%, right? That will be $33,000. And this is $33,000 is gonna use it to minus the all goods available for sale. So basically the cost of goods sold is gonna be equals the goods available for sale at cost minus the cost of ending inventory using this ratio, right? This multiple this, find out the cost itself minus the cost of ending inventory. And the goods available for sale at cost is 54,120 minus the $33,000, and that will give us 21,120. That will be our cost of ending inventory. Okay, and then the cost of goods sold, of course, we know already, right? Cost of goods sold, of course, cost of goods sold is 21,120, and ending inventory, of course, is a $33,000 as ending inventory. Cost of goods sold is gonna be this one, 21,120. Okay, chapter 10. Chapter 10 is talking about, majorly I wanted to talk about PP&E, intangible, and acquisition, right? So it's majorly trying to figure out what kind of costs needed to be capitalized, right? So first question, what kind of cost can be capitalized when you acquire a machine? What kind of cost can be capitalized when you acquire land? How can you calculate goodwill in the process of business acquisition? How to calculate interest expenses in the case of asset acquired with debt, right? And how to calculate gain or losses in non-monetary exchanging with commercial substance. What is the difference between the specific interest and weighted average interest method in terms of self-constructed, assets? And then how to determine the capitalized interest of a self-constructed asset on the specific inventory method, specific interest method. Okay. So first of all, PP&E acquisition, all you need to remember is the initial cost, which is how much cost you can book cost it. It's gonna be the purchase price plus all expenditure necessary to bring the asset to desired condition and location. So the cost of equipment can include purchase price, sales tax, transportation costs, expenditure to installation, testing, legal fees to establish the title, and any other cost to bring the asset to its condition and location for use. Such as, we give example, Beaverton Lumber purchased milling equipment for $35,000. In addition to the purchase, the Beaverton made the following expenditure: freight $1,500, installation $3,000, testing $2,000, property tax on equipment for the first year. So anytime you say annual year, prorated, a first year, those kind of words is telling you that those taxes are recurring, unless it's back taxes, right? Unless it's that kind of situation, everything else should be including the capitalization, right? So hence the initial cost of equipment should only including freight, installation, and testing, and purchase price. Okay, land acquisition. We will including purchase price, attorney fee, real estate agent commission, costs related to the title and title transfer, recording fee, any back taxes, liens, mortgage, and any other obligation. However, current portion of property tax are not included. Current portion means that your future obligation that you have in order to own this land, you have to pay. But if you help to in order to get the title, you paid for someone else late tax, then those costs are the costs that are necessary to get the land under your own ownership, right? Those costs can be capitalized. And the expenditures such as cleaning, filling, draining, and even removing, raising the old building, those costs are including. However, the proceeds from salvage material after purchase can reduce the cost of land. Okay, for example, Fullerton Waste Management purchased land and a warehouse for $600,000. In addition to the purchase price, Fullerton made the following expenditures related to the acquisition: broker's commission $30,000, title insurance $3,000, miscellaneous closing costs for $6,000. The warehouse was immediately demolished. So that means that this land is what they want, not the building or warehouse, at a cost of $18,000 in anticipation of the building of a new warehouse. Determining the amount of Fullerton should capitalize the cost of land and the building. First of all, the purchase price of the land is $600,000. Broker's commission, of course, title insurance, of course, miscellaneous closing costs, and demolition of the old building is not going to be part of new buildings cost. It's going to be part of the land cost. Okay, that's where the key is. And then, so it's asking the cost of land and the building. Building will be zero because there's no building, right? Okay. Okay, goodwill acquisition. Goodwill, we talk about in the class thing is that the main point is goodwill can never existed without a company. In other words, goodwill cannot be internal generated. It only exists when there's a business merger and acquisition. And it's not possible for a buyer to acquire its goodwill without also acquiring the whole company or portion of the company. Hence that the cost of goodwill will be the fair value of the consideration given in exchanging for the company minus the fair value of identifiable net asset of the acquiree. And how do we calculate the net asset of acquired the company? Is equals to the fair value of all identifiable tangible and intangible assets minus the fair value of any liability of the selling company assumed. Okay. Example: ProTech Software acquired all of outstanding stocks of Reliable Software for $14 million. The book value of Reliable net asset, which is asset minus liability, was $8.3 million. The fair value here, okay, the Reliable as asset and liability equals their book value with exception of certain intangible assets whose fair value exceeds the book value of $2.5 million. So what this means that is the fair value of the net asset of this Reliable Software company, which is acquiree, the one being bought, right? It should be 8.3 plus 2.5, right? Because it says everything else equals to the book value besides there's just some intangible asset has a fair value exceeds the book value for 2.5. So that will give us 10.8 fair value of the net assets. However, this fair value is also smaller than $14 million that this company, the ProTech company who trying to buy it. So the difference between this number, which is 3.2 million, okay, will equals to the goodwill of the company, right? Okay. Okay, asset acquired with debt. I think it's more clear to use in a question to demo it. Okay, so on June 30th, 2021, Kimberly Farms purchased a custom-made harvesting equipment from local producer. In payment, Kimberly signed a non-interest-bearing note requiring payment of 2 years from now. The fair value of the equipment is unknown, but an 8% interest rate is properly reflecting the time value of money for this type of loan agreement. Okay, so in other words, they bought a machine by issuing a debt, right? And we know this debt have a future value of $60,000 2 years from now. And the question, at what amount will Kimberly initially evaluate this equipment? That's a question 1. Question 2 is how much interest expenses will Kimberly recognize in the income statement for these notes for the year ending the first year of borrowing, right? So first of all, if we don't know how much, we know how much it will worth 2 years from now. Today, we had this machine. We bought this machine, but we didn't pay a penny. We said that in 2 years from now, which is 2023, 2022, 2021. So 2023, we will pay this person $600,000. So in order to record this machine today by debiting machine and crediting notes payable, how much we should value this machine? Okay, so here's the thing. The $600,000 is a future value, right? So in order to calculating the machine's cost, it should equals the present value of $600,000. And then when we're using present value, we needed to using present value of $1 table, right? This table. And then we needed to n equals 2, right? Because 2 years from now, and I, it told us, is 8%. And then when we go to that table, we find out that this ratio, this discounting ratio, it actually equals 0.85734. Okay, hence that the machine costs should equals to 600,000 being discounted by 0.85734. So it's gonna equals to 51,440. So we were debiting $51,440 here, and then the notes payable is a $600,000. Hence, that debit doesn't equals credit. What do? We're missing one debit side. We need a debit discount on notes payable, right? The discount is gonna be equals 600,000 minus 51440. But that's not the point. The point is so first of all, we answer the question. The machine's cost is gonna be 51,440. And the second question is trying to figure out our interest expenses. Interest expenses is always going to be equals the carrying value of the debt multiple the interest, right? Interest rate. So we know that the carrying value of the debt from June, right? June 30th, 2021 is 51,440, and the interest, the carrying value is actually the machine's cost, right? It's right here. It's gonna be 51,140, and then the interest rate is 8%. But be careful, you only carry this note for half year because it's asking the ending on the year 2021. So June 30th to December 30th, 2021 is only 6 months. So that will be 6 divided in 12, right? Hence that means that the interest expense is only going to be 2,058. Okay? So when you look at this kind of question, the first thing you know that you need to understanding using PV1 table, right? Because it gives you a lump sum of payment in the future. You want to discount into today. Second of all, once you figure out what's the machine's initial costs, then you know that this debt that you're carrying has a carrying value. And then to calculating the interest expenses, you need to using carrying value multiple the interest rate. But be careful about how long this note has been issued, right? If you bought this machine in the middle of the year, you got to figure out the month, the fraction of the month, right? Okay, so non-monetary exchange. So in other words, non-monetary exchange means that there's no cash involved, and you need to figure out. It's kind of like fixed asset exchanging fixed asset, or fixed asset exchanging intangible asset. So how do we do that? First, you got to record the new asset at the fair value, and the fair value is determined by the fair value of the asset given up or the fair value of asset received. In normal exchange, we expect those two equals. Number two is that you want to remove the value of non-monetary given, which is crediting out the old asset, right, and debiting the depreciation, accumulated depreciation. Then you're gonna record the cash involved if there is a cash payment, right? If you receive cash, you debit cash. If you pay cash, you credit cash. And then you're gonna figure out whether there's a debit equals credit. If debit is bigger than credit, you record a gain. If debit is less than credit, you record a loss, right? So the gain and the loss on exchanging equals the difference between the fair value and the book value of the asset given up. So in other words, the gain or loss is always equals the fair value of the old minus the book value of the old machine, okay? And if that fair value is bigger, then you have a gain. You realize the gain. If the book value is bigger, then you have a loss, right? Okay, let's look at an example. Kalavasara Tire exchanging equipment for 2 pickup trucks, right? The book value and the fair value of equipment giving up is $20,000, and you know, the fair value is 2017. So the book value of the old is $20,000. Okay, the fair value of the old is $17,000, right? And then this $20,000, he said, is because the cost was 65, accumulated depreciation is 45. Assume that Kalavasaras paid $8,000 cash in exchange. So also there's a cash for $8,000. So at what amount will Kalavasaras value the pickup trucks, right? So the new pickup trucks will equals the fair value of the old plus cash paid, which equals fair value of the old is $17,000 plus cash of $8,000. It's going to be $25,000. Okay. And then is there gain or losses? We say the gain or losses is all depending on the fair value of the old minus the book value of the old. Fair value of the old is $17,000 and the book value of the old is $20,000. Hence, it's negative $3,000 of loss. So if we do a journal, we were debiting accumulated depreciation for $45,000, right? And we were crediting old truck for $65,000. So that's, we get rid of it. And then we were crediting cash for, because we paid, right, for $8,000. Hence we were debiting loss for $25,000. Okay. Oh, we were debiting loss, sorry. We were debiting loss for $3,000. Right? So this two adds up is actually $20,000, right? And the cash paid is crediting $8,000. So this side is $73,000. And then something, oh, no, debiting new truck. I was wondering. Debiting new truck of $25,000. So now we are balanced. Right, because the credit side is $73,000 and debit side is $73,000. Okay. Okay, interest capitalization for self-constructed assets, right? So I think the demonstration is important, and this is very important. Okay, on January 1st of 2021, the Highland Company began construction on a new manufacturing facility for its own. The building has completed in 2022. The company borrowed $1.85 million at 10% from January to help financing the construction. In addition to the construction loan, Highland had the following debt: $4 million at 14% and $1 million at 10%. And the construction expenditure incurred during 2021 was January 1st for some, and then March 31st, 1.4 million, June 30th, 1.04 million, September 30th, 800,000, December 31st is 600,000. So you wanted to calculate the amount of interest capitalized for 2021 using specific interest method. Specific interest method means that you wanted to trace the construction loan using this as apply to it to 100%, right? And then if there's a leftover, then you go weighted average of the interest. So I will show you what I meant. Okay, so first of all, we need to find out the weighted average. In other words, just say average of the cost outstanding. Average costs of construction expenses, right? And then based on the timing, this is January, March 31st, June 30th, September 30th, and December 31st. So based on this, we need to figure out how much is actually throughout the year. So if you're starting 800,000 since day one, that will multiple 12 over 12. And then from March 31st, you will multiple 9 out of 12. From 1.04 million starting in June, you will multiple June 6 over 12. From 800,000 starting September, you will multiple 3 over 12. From December 31st, that one day is basically 0 out of 12 because it's just one day. By calculating this, the first one you will contain 800,000. The second one is gonna be 1.55 million, and then the third one is gonna be 520,000, and the fourth one is gonna be 200,000, and the fourth one is gonna be 0. And this all together is gonna be $2,570,000. This number, first of all, you should consider, was this number 100% can be supported by construction loan? Right, so the construction borrowing is only 1.85 million, right? So that means that this loan, it needed to be using specific interest rate, which is 10%, okay? And then the leftover, which is after you use 2.57 million minus 1.85 million, that will leave you about $720,000. And then this half $720,000 will be funded by other loans, and then which is these two loans, right? There's two loans, then you need to figure out what's the interest expenses that I can use. Interest rate, right? I know the construction loan, no other negotiation is a 10%. And then how do I use, there's a two loan outstanding. One is a 14%, one is 10%. What am I going to do with this? Hence that we wanted to use weighted average interest rate. How do we do that? What we do is that we use a $40,000 multiple 15. We got the interest of 560,000. And we use a 1 million multiple 10%. We know that the whole year interest is going to be 100,000, right? And then we're adding 560,000 plus 100,000. And we're dividing the total borrowing, which is 5 million. And then this gives us the weighted average of interest rate of about 13.2%. Hence, the leftover 720,000 is going to be 13.2%. And then that means that the construction loan funded our interest, funding this loan, construction expenses for $185,000 of interest. This is interest, right? It's going to be 100% capitalized. And then 720,000 multiple 13.2%. This is going to equals $95,040. This one is also going to be interest expenses. It's also going to be capitalized. So then you were adding 185,000 plus 95,040, which is going to be $280,040 as interest capitalization. Okay, so this means that before you applying the other weighted average rate, you have to make sure that this average construction cost apply to 100% the construction loan first. And then if there is more than the construction loans borrowing, then you will go ask for help from the other borrowing, right? And then, but there is another method, it's called alternative method, it's called a weighted average method, which does not trace specific construction loan to calculating the interest capitalization, but mingle all debts outstanding to calculating weighted average interest expenses. So in other words, instead of first give this 100% the construction loan outstanding charge at 10%, the weighted average rate method is trying to including this 1.85 million at 10%, and then equals 185,000, and then mingle this whole thing together, which is gonna equals 560,000 plus 100,000 plus 185,000, and then dividing 5 million plus 1.85 million is 850 million, right? And then calculating a rate here, and then directly multiple this question mark, which let's say 8% right here, right? This is weighted average. Instead of specifically let this $257,000 apply 100% because of construction loan borrowing left it over, okay? And then what left over applying to the other loans. So this means that so these two methods, okay, will always result in the same interest expenses, except the construction loans debt rate, interest rate, is different from the rate of other borrowing, right? So in other words, when company trying to funding a self-made PP&E plants or property, you know, they can capitalize those interest expenses, but at the same time, you have to consider, did they borrow specifically for the construction, or they just use whatever outstanding loans or line of credit they have to funding it, right? And then usually the construction debt's interest rate would be different from the other line of borrowing, right? Okay, but these two methods will always have a different answer, right? But unless that those two, the construction debt and other interest-bearing debt has a similar interest rate. Okay. Okay, chapter 11, which we just learned, and I know that your memory is still fresh, but still I wanted to make sure that I because there's a lot of stuff, so I want to make sure that I tell you what will be exempt. Okay, what I will want you to know is that how to calculating partial year depreciation method on the double declining method. So first, that means that you have to know what is double declining, and then you got to be careful, is it a full year depreciation or partial year? And also I want you to clearly understand the difference between straight line method and double declining method in terms of service life, depreciation ratio, and allocation base. And what is the benefit of activity-based depreciation method versus time-based method, right? Very theoretical. And then how to calculating gain or losses in terms of fixed asset disposition, and how to calculating depletion cost of natural resources, and how to record R&D cost, and how to amortize the software development cost. I have stressed this in the class. Okay, let's see. Partial year depreciation or amortization. On March 31st, 2021, Kensico Plumbing Fixture purchased equipment of $30,000, and the residual value at the ending of the estimated 4-year life is expected to be $2,000. The company expected the equipment to operate for 10,000 hours. The equipment operated for 2,200 and 3,000 hours in 2021 and 2022 respectively. Calculating the depreciation expenses for 2021 and 2022 using double declining method. Okay, so first of all, the double declining method, starting year 1 is using the real cost, the whole initial cost. You don't need to minus the residual value, right? Okay, that's the first thing. And then the rate that we are declining at is gonna be 2 multiple 1/4, because double means 2 multiple 1/4 service life, and service life is 4, hence it's 20%. Multiple 2 is gonna be 50%. So that means in 2021 we needed to depreciate 50% of $30,000. However, be careful, we are doing partial year because this machine was bought on March 31st, 2021. Hence that means that you only have how many months? 9 months out of 12. Hence that 2021's depreciation cost is $11,250. And the 2022, you got into using the carrying value of the assets, right? Starting from 2022's January. So it will be $30,000 minus the depreciation will be the carrying value. Then you multiply the full year of 50%, which gives you 9,370. Okay, so then the recap is that the straight line versus double declining. Straight line's method allocation base is gonna equals initial value minus residual value, right? The double declining method's allocation method is only the initial value of the assets. Okay. The straight line method, the depreciation rate is going to be 1/4 service life, and double declining where the double come from is here. It's equals to 2 dividing the service life. Okay. Activity-based and the time-based depreciation method, the comparison is more conceptual, right? So first of all, time-based depreciation depreciates the fixed asset based on the elapse of time, right? No matter it's double declining, straight line, it's all because of time. Time elapsation will causing the machine automatically depreciation. And the activity-based depreciation method depreciates fixed asset based on utility. How many units in total that this machine can handle, and how many units I produced this year will be the depreciation method. So hence that the third point is most important. The activity-based depreciation method provides the better matching of asset cost to the use of the asset to help produce revenue. Of course, elapse of time does not really mean that the machine is used. However, if you use activity-based depreciation method, that means that you're really trying to figure out how does the asset life or cost contributing to the production, and the production will result in the revenue. That means that the matching between the cost and revenue is more close to reality, right? Okay, so fixed asset disposition, we usually will wanted to figure out whether there's gain or losses, right? And the gain or losses is recognized as a difference between the consideration received and the asset book value. So the selling price, which is the consideration received, can be cash, can be another assets at the fair value. And then you're gonna minus the book value of the old asset, which is original cost minus the accumulated depreciation. And then these two numbers minus each other, then you can figure out whether we have gain or losses. Okay. So let's look at this example. Lawler Clothing sold the manufacturing equipment of $16,000. Lawler originally purchased equipment for $80,000 and depreciated so the date of sale for $71,000. So that means only $9,000 is the book value, right? And then if the manufacturing is sold for $16,000, which is a cash for $16,000, that means $16,000 minus $9,000. That means it's gonna be $7,000, which is gonna be the gain. And then the journal entry, of course, you're gonna debiting the cash for $16,000. You're gonna get rid of the equipment, right? By crediting the equipment and debit accumulated depreciation, and you're gonna recognize the gain for $7,000 on the credit side. Okay, so and the depletion of natural resources, usually remember we wanted to use activity-based method instead of elapse of time. So how do we do that? First of all, we wanted to figure out the depletion base, which is the cost minus the residual value, and we wanted to figure out depletion per unit, which is depletion base dividing estimated extractable units. Here, sometimes we will still give you information about the service life, but the service life is just gonna be the estimated amount of natural resource that can be extracted. But what we usually do is using the activity-based unit of production method. For example, Fitzgerald Oil and Gas incurred a cost of $8.25 million for the acquisition and development of natural gas deposit. The company expected to extract 3 million cubic feet of the natural gas for a 4-year period. Natural gas extracted during year 1 and 2 was 700,000 and 800,000 cubic feet respectively. What is the depletion for year 1? So first of all, depletion for food is gonna be using 8.25 million. Here it didn't say residual, which is 0, then you just directly use it as a numerator. And dividing 3,000 cubic feet, which is $2.75 per foot. And then you can multiply the first year's production, which is 700 feet. Then you can find out the cost of depletion is 1.925 million. Okay. So last thing that we wanted to I want to examine is going to be research development cost of amortization. This is going to apply to the software development cost. Okay, so amortization of capitalized software development cost begins when the product is available for sale. Okay, general release, and the periodic amortization percentage is the bigger between the percentage revenue method and straight line method. So we say that in the R&D process of the software, right? So the day one you decide this project to the technology feasibility, this whole process is going to be definitely R&D expenses put on the income statement, okay? And then from technology feasibility to the launch of the product, which is the release of product, we can capitalize this. And then we call it software development cost. And this cost can be amortized, okay, over the period between the launch of the products to however many year that you think you need to sell this product. And then each year's amortization expenses is gonna comparing the percentage of revenue, or whichever one is bigger is a straight line method. Okay, so let's look at this example. In early 2021, the Excalibur company began to developing a new software package, okay, to be marketed. The project was completed in December 2021 at a cost of $6 million, of this which $4 million was a spending before technology feasibility, and the Excalibur expected a useful life of 5 years for a new product with a total revenue of $10 million. Okay, during 2022, the revenue was a generation is a $3 million was recognized. So first I'll prepare the journal entry to record the development cost. So hence that the technology SATF technology feasibility, this whole thing is a starting in early 2021 and finish in ending 2021. This whole thing cost them $6 million, right? And then only $4 million was a spending before the feasibility, technology feasibility. And then that means $2 million can be capitalized. Hence our debiting R&D expense for $4 million, our debiting software development cost for $2 million, and our crediting cash for $6 million. Okay, and then second, so what is the required amortization for 2022? So this is 2021, so December 2022. So this is gonna be how we amortize this $2 million, right? There's two methods. First, a percentage of revenue method versus a straight line method. So straight line is easy. Straight line, it says 5 years of life, and then it's the cost is $2 million. So that means that each year I should amortize $400,000, right? And the percentage of revenue means that the $2 million multiple, $3 million revenue was recognized for that year, but its total can recognize $10 million in the future. Hence that means that on the percentage of revenue method, I should recognize $600,000, right? And then I will use the greater one of those two numbers. Hence I will use this number. So that means that calculating required amortization is gonna be $600,000. And so 3, determine the amount reported for computer software costs in December 31st, 2021 balance sheet. So on the balance sheet, of course, I have on the asset side, right? I will have a software development cost, this item, and I will wrote $2 million as a cost. I will minus $600,000 as amortized to date, and I will equals net software cost, which is $140,000. Okay. Oh, $1,400,000. Okay. Okay. So this concludes all our review for exam 3, and it has been a fun and a great semester and you guys are brilliant, and I myself sometimes feel pressure because I wanted to make sure I teach teach well, and you guys are doing really good, and I hope this video can help you to prep your exam 3, and good luck. I will see you guys here and there on the campus, and then maybe I can teach you guys more classes in the future if I got to assign accounting intermediate 2 or advanced accounting. I'm looking forward to that, and good luck on everything. Thank you very much.